Panelists for the Domestic Opportunity Zone, please come on up. That would include Brian Bandell, Brad Molotsky, and Steve Kreinik. Brian Bandell, as you know, if you don't know, he is the senior reporter for the South Florida Business Journal. He's won more than 25 awards, and in the real estate business, if you do not know who he is and you're not talking to him on a regular basis, you really don't know what's going on. Brad Molotsky, as we playfully refer to as the Wizard of Oz in the legal world, heads the area of real estate law for Duane Morris, serves on the lead team for project development P3 industry groups, and is the co-head of the firm's Opportunity Zone practice. Steve Kreinik is a partner at Eisner. He is a tax partner and has been there doing it for more than 20 years, and he is on the accounting version, also referred to as another Wizard of Oz. So we figured we had just phenomenal talent here. We kept it short and narrow and let Brian take off with the questions.
Good morning, everybody. Well, beautiful morning in Miami here. So let's get a short overview of Opportunity Zones for everybody. It was created by the Non-Controversial Tax Reform Act. It creates census tracts throughout the nation that were selected by Treasury and the governors. You can invest in real estate and businesses there and get your capital gains deferred. So basically, if you sold a property, made a nice profit from that, you want to avoid paying taxes immediately, you can invest in an Opportunity Zone, keep it there long term, and reap the benefits, and hopefully uplift these communities. So let's start with our first question. I guess we'll have Steve answer first, and you guys can go back and forth. How much time is left to participate in the Opportunity Zone investment program here?
So you actually have till the end of 2025 to make investments, unless they change the law. But in order to get the 15% deferral on your initial gain, you would need to invest by the end of this year. And in order to get the 10% deferral on your initial gain, you need to invest by the end of 2020, 2021. So, I think there'd be some push for the end of the year to get some investments in. But overall, there's still plenty of time to participate. So I think initially it was hurry up. Everyone was really excited about it and, wanted to get their money in as quick as possible. And then we've definitely seen a slowdown over the last 6 months or so. People taking a step back to make sure it's really right for them.
And Brad, tell me a bit more about what you're seeing with the timing. Are people in a hurry to meet the deadlines, or are they still trying to figure out how this works?
A little bit of both. And so let's just step back for a half sec, if that's okay. So how many people in the audience think they're like 301 experts on Opportunity Zones? Come on, just somebody's got it. There we go. One. How about 201? Kind of advanced beginner, intermediate? Couple, brave souls. And then 101. No, don't be shy. 101, we're learning. We're kind of trying to figure it out. Okay, so let's take a half a second and just unpack it. There are three big benefits to the Opportunity Zone, as just alluded to. You get to defer paying capital gains until the end of 2026, so pay later, not now. If you're in the program, the second benefit is reduction. If you're in the program for 5 years, you get to reduce your capital gain amount by 10%. If you're in the program for 7 years, you get to reduce your capital gain amount by 15%. So deferral, first benefit, reduction, 10%, 15%, if you're in for 5 or 7 years. At the end of 2026, as it alluded to, you pay the tax you would have otherwise paid today, 24.5% to the federal government, lovely, but you pay it as reduced. That's not the magic of the program, friends. The magic of the program is if you invest in a fund, in a zone, in real estate or a business, which all of us are involved in, either a business or real estate, mostly in the business of real estate. If you invest in one of these zones and you stay there for 10 years and then you sell the business or the real estate before the end of 2047, long time, 100% of the capital gains on the appreciated value in the investment is federally capital gain tax free. FREE, no cap. So if we put $1 million of capital gains into an investment and the $1 million grew over 10 years to 10 million, 100 million, a billion, there is no federal capital gains paid on that on the exit, so long as you sell before the end of 2047. That is what's generating a lot of this interest and a lot of focus and a lot of people's learning. And so, to your question, the long one, Mr. Toad's wild ride to get there. To your question, yes, people are excited and paying attention, and it's driving people's behavior to invest before the end of this year, because the way that 15% 7-year benefit I spoke about is counted is a little bit weird. You count 7 years backwards from 2026, so 7 years equals the 15% benefit. That takes you to 2019, that's this year. So in order to get that 15% reduction, you need to invest your capital gains dollars into a fund before 12/31/19. As indicated, you get 10% in 2020 or 2021. That's 5 years backwards from 2026, okay? So again, deferral, reduction, elimination/freedom, and people are responding to the 15%.
Okay, I think we've all graduated to the master's level class. Thank you. So what should investors know about setting up a fund to invest in opportunity zones? How should we structure this?
Generally, you need to set it up as a tiered structure, but it's not as complicated as it may sound. I mean, you just need to. You're going to set up one entity that's going to take all the deferred money in, and then that entity is going to make investments into one or more other entities that are in the opportunity zones. So it's not as simple as someone going out and just buying a piece of property and that's it. That won't qualify. So you definitely need to get to Duane Morris and have it structured correctly. But it's also not overly complicated or costly to get it set up.
But you can pool multiple investors together who are of a similar situation, right?
Correct. So when you set up this initial fund, you can have as many investors as you want invest in that fund with their, and it doesn't necessarily all have to be opportunity zone money coming in, deferral money, but it gets a little more complicated if you have a mix.
Yeah, I second that emotion. The setting, you guys have heard about there's getting a lot of press these days negative about the program. So the New York Times and some others have taken shots at the program about the program being about a bunch of rich guys from the suburbs that are cronies of the president taking advantage and essentially building pet hotels. That is not untrue. So there is some of that going on, but there's a lot of other deals that are also going on that are good deals that are solid for investors and solid for the sponsor. And so to the question, there are these funds that we're trying to raise a lot of money, 500 million, 700 million, $1 billion. If you were Scaramucci's fund, Skybridge, you were trying to raise $5 billion. Well, that gets a little tricky with some of the rules. And so the larger the fund, the quicker you need to deploy that money. And so it's relatively easy to spend $1 million, 10 million, 20 million, 50 million. It's less hard to spend $5 billion in 30 months. And so these funds have not done so well. That doesn't mean that the program's not doing well. And so a fund can be the Brad and Jay LLC fund that takes 1 day to set up. Capital gains from 2 people go into the LLC, and off you go. So it doesn't need to be one of these tricked out Wall Street funds. It can be, but it doesn't need to be. And so to your question, that's a day to set that up and a day to file the paperwork with the relevant state corporations bureau. So these things are relatively easy, despite what you hear from a lot of people. The rules are not that complicated. You just need to understand them. The benefits we already talked about, deferral, reduction, freedom. So you guys are now 201 players.
Yeah, it sounds a little scary to deploy that much capital in a short amount of time to too many opportunities for mistakes. So what opportunity zones in South Florida are you seeing the most interest in? I'm talking about specific neighborhoods.
I've seen it around the design district, but probably the most that I've seen is actually more central or northern Florida. I've seen a lot of interest up there, and I think one of the challenges down in South Florida is what property there is in the opportunity zones has greatly inflated in value. So it's made it a little harder to get deals done, and but there's still a lot of interest down here, and I would say Florida overall, from what I've seen, is one of the hotbeds. Some other states have also added incentives to make it, added state incentives to make it even more lucrative. So some of those states are doing well also, but definitely a lot of activity down in Florida.
Yeah, I agree. We're seeing deal flow throughout the, so step back. All 50 states have zones in them. Some are urban, some are rural. Puerto Rico, a lot of the island is a zone. We'll hear a little bit later about the U.S. Virgin Islands and the zones that are there. And so every state has them. The activity has been good to very good in Florida. And so where are these zones? It's easy enough. Do you find it on your iPhone? You can do it now if you're bored. If you just type in like Florida Opportunity Zones, it takes you to a site that each of the governments, the state governments put up. The mapping technology is very good. You can sort of move around like, you know, Apple Maps. Apple Maps? No, whatever, you guys are with me. Or you can type in an address and it'll take you there and tell you whether you're in the zone or not. So the deals that are going on tend to be, at least from what I'm seeing, focused for the moment in the urban areas. So there's a huge zone in Orlando. Orlando, the market, as you all know, I suspect, is on fire. And so in the middle of Orlando, by the new basketball stadium, that's a big zone right there. And so there's a lot of activity going on there. In Miami, there's activity happening. I was just talking to somebody yesterday about a $30 million deal in Little Haiti. There's a bunch of stuff going on in the Arts District. There's some other activity in Tallahassee that's happening as well. So again, your urban cores tend to have these zones, but they're also, and while they tend to be in trickier areas, that some of them are less safe than others, there are many areas that are very good. And so that's where people are kind of looking on. The guy from CoStar is probably somewhere in the audience. He was here yesterday, talked about kind of on CoStar, you can type in opportunity zones and you can see exactly where those zones are for purposes of talking to your clients, whether it's an owner that may not know they're in a zone, or whether it's, you know, a prospect or even a tenant, whether it's landlord or tenant, they may not be aware that there are benefits. Remember, I said real estate and business. And so any tenant that is moving into one of these zones gets the opportunity, bad pun I guess, to participate if they follow the rules. So a tenant would be the same as the real estate. If they invest capital gains and they stay in somebody's property for 10 years and thereafter sell their business before the end of 2047, the tenant gets the benefit as well. And so an attraction and a retention tool, attraction by the owner, are they going to get more rent? Probably not, but they're going to be able to keep somebody there for 10 years if these people are paying attention and interested in the benefit. So again, for you leasing brokers, attraction and retention tool and a discussion point with owners who may not be aware that this exists. For you investment sales folks, again, for the buyer or even the seller, if your seller is reaping a lot of money and they have capital gains, you have the opportunity to help them understand the program and where they can save some money, which is a value add.
Well, I'd imagine if you're a tenant, say you have a restaurant, maybe you could get some new investors into your business who wanted the further capital gains. That might be a nice little benefit, get a little extra capital.
Exactly, and those new investors get that benefit of deferring their capital gain, reducing it by 10 or 15%, hopefully if they do it in the next 3 years. And then ultimately when they sell their investment, so long as they can hang in there for 10 years, then it works. And that sale price, whatever the upside is federally capital gains tax free, so you're saving 25%. Much more flexible, much better, more robust than a 1031. So a 1031, most of you I'm sure are familiar with, but the ability to sell real property and roll that gain into the next site. This program, the OZ, is more flexible. It applies to not only real estate, the 1031 is only real estate, but the program applies to personal property. So anything in your house. So, art, furniture, fixtures, clothing, jewelry, Bitcoin. I'm sure you have gold bullion sitting around your house. But it also applies to stock, whereas a 1031 does not. So if we sold Google and we had or Amazon or whatever, and we sold that and we had a gain, the ability to take kind of market gains and put them into hard assets now and then make the appreciation in that asset tax-free is a pretty powerful tool.
Now, do you think these opportunity zones are spurring new development in these areas, or they're largely just an extra incentive for development that was probably taking place regardless?
Yeah, so I think that's some of these recent time stories and that's some of the controversy out there that, people, certain, very wealthy people have gotten big deferrals on projects that they would have done anyway. But with any tax law or any rules, there's always going to be the people that, the initial adopters of the rules, and overall they made the rules pretty taxpayer friendly. They tried to prevent abuse, but there's always going to be people that take advantage of the tax law. So I think initially I would say a high percentage of the deals that got done in the first year were deals that probably would have happened anyway. But I think now, over the last year, you're seeing other deals come into play. And, with the rules for businesses, they've made it very easy for businesses to locate and qualify in opportunity zones, and those rules were just clarified, several months ago. So I think you'll see a lot more activity on that front. So again, as far as, with tenants leasing in these areas, I think they've made it very easy to qualify as a business in the zones.
Yeah, I agree with that. I think that we're seeing a lot of deals that are ground-up construction, but we're seeing a lot of deals that are also adaptive reuse. So the ability to take older inventory, change it. So whether it's a warehouse becoming an apartment building becoming, a hotel, whatever it would be, the change of use and the investment of additional dollars into a zone, we're seeing those deals as well. They're a little bit harder because you need to get zoning approvals, you need to get kind of plans put together as opposed to building a new building, which can also be hard. You still need to get plans put together and permits. So we're seeing kind of both flavors. And I think that the underpinning of the program was to drive, private capital into trickier areas that were low and moderate income based on HUD census data. And so whether people were already going to do that, or whether they're now looking for those opportunities, or whether they're looking to monetize those opportunities, it matters, but it almost doesn't matter in the sense that the appropriate amount of investment, i.e. private capital going into low, moderate income areas, is occurring. And so you are getting an ancillary effect of job creation, hopefully with local zip codes, that should stay there once the buildings are built and during the construction.
Is there anyone from the audience who has a question? Raise your hand. Okay, stand up and speak up so we can hear you, please.
I have a quick question about self-dealing with regard to the opportunity zones. If you already own property, transferring them into another vehicle.
So the question is self-dealing. So there's a rule that, let's step back. Optically, you selling to yourself and being able to defer and reduce doesn't look so good. They don't want, folks, the rich suburbanites, not the rich, rich suburbanites kind of making money on the program. That wasn't the idea. And so there's a rule that says if you're a related party, you can't benefit from the program. So what's a related party? A related party is, day one, you might own a property. If you sell it and you own more than 20% or more of the buying entity, you're deemed to be related, and that will not work. And so people were saying, well, if I own this property and I don't want to sell it, how can I monetize and how can I participate? And there's a couple of ways. You could ground lease to somebody that could, so you could take ground lease revenue. That's a little tongue twister there. You could take ground lease revenue and let the third party build and get the benefit. That would be one. Two, you could sell to NewCo. NewCo pays you cash. You can take the cash, that's your gain, reinvest it in NewCo. That's okay, so long as you only own 19.9% or less of the equity in NewCo. It's not a control test. You can still be the general partner. You can still control day to day, but it's total amount of equity. So 19.9% is kind of the bogey you want to stay below, and that's deemed not to be a related party. There's also some aggregation tests on husbands, wives, direct lineals. That's a little bit beyond today, but we can chat about that offline.
Okay, great. Well, thank you for your wonderful answers. I think we all learned a lot about the Opportunity Zone program. I think we have to move on to the next one, right? Okay, thank you.